Welcome. Right, this is day 3. This is day 3 of company. Welcome. All right, welcome. There's about 4 of you. We're going to start in a little bit. I'm basically just getting everything set up. I'm quite surprised because this morning for you, morning, when I was looking at the market, down, and I think people were a little bit worried about jobless rate being expected better than expected, but I'm not sure what actually happened in the last hour or so. Index has been down. Yes. That's the 323, India 175, so 202. I mean, these are actually still above 200. I was buying this in my other account. Yeah, I see that. Amazon 1, Apple 5, Microsoft 5 or 6. But I wouldn't really call it down.
Oh, give me a second. I just realized the comments are off again. Goodness. How did I fix it the last time? I think I went in here. I think the thing is when I set this up through StreamYard, somehow or other, some of the things don't get set up through YouTube. So I guess I should set it up directly on YouTube. Are you able to type in the comments now? I think if you refresh the stream, let me know if you can type in the comments. Let me just take a look. So today is day 3. We'll be talking about C Limited. All right. Okay. So I see some comments. I'm just trying something out. Let's see whether this works. All right, welcome to the 5 people in the stream, 6 people, depending on how many. Today this is basically the 3rd day of going through 10 companies in 10 days, and the company that we are talking about today is actually C Limited. Now, C Limited is, or in Singapore, a lot of people call it Shopee or call them Shopee. So because of that, during this little discussion, if I use the words Shopee interchangeably, I'm not just referring to that one particular segment of their business, but C Limited as a whole, and I'll try and catch myself. All right, let me see. Yeah, so before I do that, let's just take a look at the price of C Limited today. So today, C Limited. All right, I mean, after the recent boost that they got from earnings, slightly down, 178 today. Are they down today? Yeah, down 0.1%. I mean, pretty much flat on the day. It's on the weekly candle. So you can see that this gap up over here was from their earnings. We'll cover a little bit of their earnings during the discussion later on. All right, so let's get into it. Does this work? I think it works. Okay, I think we will, yeah. I think this should work. Okay, so like I said, today we are going to be talking about C Limited. C Limited basically owns a couple of businesses. So C Limited themselves, they have already told us in their 10K or in their 20F, they are basically a holding company, right? They do not have any substantive operations, and they have 3 core businesses. So basically, they have an e-commerce business that is Shopee, and that is how usually people in the Southeast Asian region refer to them. I think a lot of people don't actually know that apart from Shopee, C Limited actually owns a digital financial services, which is Mari Bank, or in certain parts of Southeast Asia, they are also known as C Money. Now, I think recently they just rebranded themselves to be known as Money, MONEE, right? As well as digital entertainment, which is Garena, and they actually have popular games such as Free Fire. I think they have a couple of others. I saw that they are working with EA Sports for the EAFC and things like that, but I think the most popular one, at least within the region, is Free Fire. And so basically the whole discussion today will be taking a look at their story over the last couple of years, how they actually went. If you take a look at the stock price movement, it's actually quite drastic, as you will see it later on. And basically, we're going to discuss what some of the steps they have taken to help the company recover, whether or not this recovery that we currently see them in, whether this is something that can be sustained throughout the next couple of years, right? So that's basically what we're trying to do today. And at the end of the day, we'll run them through the framework that we have been using over the last couple of days, the 8 parts, to determine, what sort of company they are, whether or not they are a company that is worth our time investing in, and what are some of the considerations if we want to invest in this company going forward. All right. So basically, if I'm not wrong, yes. Okay, this is working. So basically, they are an internet, they brand themselves as a consumer internet company. They have 3 main segments. Okay, so the first segment of their business is Shopee. That is the largest e-commerce platform in Southeast Asia and Taiwan, and they have a rather big presence in Latin America. I think primarily Brazil. They have divested away from a lot of their other South American connections like Argentina and Chile and Mexico and things like that. So this is basically done through a mobile app, and it's a highly scalable marketplace. So that's according to them. This can be found in their 10K or in their 20F. Right. The second segment of their business is their financial services segment. This is branded as C Money, which is a leading digital and financial services provider in Southeast Asia. So I think a lot of people have this misconception, which is how I titled the video today, is C Limited the Grab killer. Actually, I think fundamentally both of them are fairly different businesses. I think C Limited is more within the e-commerce space. However, Grab is more in the food delivery space. However, the one overlap that they do have is their financial services platform. However, they are both going about it in two totally different manner, different strategies. Technically, they are still going after the same unbanked population, but you can see the geographies that they are working in is actually very different. So if you take a look at C Money later on, you can see that primarily their focus is to expand within Indonesia and the Philippines. However, in Grab, they are starting, in a sense, their home base, which is in Singapore and Malaysia, right? So basically, GXS is expanded in Singapore and Malaysia. So then the third segment of their business is Garena. Garena basically is a gaming platform. I didn't even know, honestly, as a Singaporean, that they belong to Shopee at the start. Or the company that owns Shopee at the start. This is how detached this brand Garena is. I've always known it as a gaming platform. In the past, they used to host a very popular game, Dota, which is similar to League of Legends. However, I believe now because Dota has been, I think, remade by Valve, so they are now powered on Steam. And I mean, apart from that, at the same time, they C Limited has also taken steps to actually move towards a more mobile-first approach when it comes to their gaming platform, right? So, like I said, if you take a look at the stock price over the last couple of years, you can see that during the pandemic, they really benefited from people being cooped up at homes, spending a lot of time on their platform, and so because of that, I think you can see the stock price rise. But I think a lot of this was very momentum driven, and so during 2021, as the broader stock market correction happened, this took C Limited down over 90%, all the way to $30-$40 range. Now, for me, at that point in time, this wasn't really. I think personally, for me, I have come to realize I have certain biases against some of these companies because I'm not someone that engages in a lot of online shopping. Like, I prefer to do my shopping in person because I want to feel, touch, and see the products. And so because of that, I've never really considered them as an investment previously. And I think it's only as I started to cover Grab that I started to think that I should really give this company a look. And I think people have been asking me because they're interested in Grab whether or not there are opportunities that actually overlap for these two companies. But I think the overlap really isn't as bad as a lot of people thought. So basically, from there in 2021, after the decline, they realized they couldn't just, continue their operations as per what they were doing. And so because of that, they went on they took some pretty aggressive actions to basically correct the course of the company and to actually turn it around. So what we're going to do is to explore the story of C Limited today and to basically understand, where the actions they have taken or how the actions they have taken previously has led them to where they are today. And then you can decide for yourself whether or not this is a competent group of management. Okay. Up to now, is there any questions so far? While I take a sip. Right, if there's no questions, I will carry on. SoFi for the win, definitely. I mean, I think they're up today, right? They're up nearly 2%. So I think my covered calls and my cash secured puts are basically in a pretty good position. I mean, as long as it stays within $20 and $26 over the next week, I think I'm good. So yeah, I think one of the things that definitely skews me or my own bias when I look at some company like Shopee is that because they also have a financial services side of the platform, and I'm so used to seeing numbers that are being put up by SoFi that I have to realize that what is SoFi standard might not be the industry standard, and Shopee's financial services side of the platform might actually be decent as well, and that is something we're going to explore later on. So the first thing that they did when they started to realize that there were a lot of unprofitable segments within their business is that they started aggressive cost cutting. So one of the things that happened back in, I think this was in 2022, Free Fire for some reason was banned in India. So at the same time, since India banned Free Fire, Shopee took the opportunity to withdraw from India as well. And at the same time, I believe during that period, they not only withdrew from India, they actually also withdrew from countries like France, Spain, and a large part of Latin America, which is why they're only focused in Brazil right now. Right. So I believe they also left places like Argentina, Chile, Colombia, and Mexico. And they started only focusing on growing their presence within Asia and Brazil. So after streamlining operations, I think Forrest Lee, who is the CEO, and his management team really took things a step further. Apart from just slashing their operations, the management team actually took a cut of their salaries. I think for the entire year, they did not receive any cash allowance from the business. And I think there were basically a lot of, unfortunately, freezes to salaries and a lot of basically retrenchment during that period of time, a lot of cost cutting. Right. So, but this in turn, for the business was actually good, right? That despite it being, unfortunate on an individual basis, but for the business of Shopee or for the business of C Limited, it reduced their operating expenses and as well as reduced their cash burn. And so all this was done towards the end of 2022. But for where the business was at that point in time, I think it wasn't enough just for them to be cutting costs. They needed to increase their ability to monetize the users on their platform, to monetize the sellers on their platform. And so therefore, apart from doing all these cost cuttings, they increased their take rates and their fees on the platforms, and they actually introduced all these platforms advertisement, or actually started to drive more traffic towards their on-platform advertisements. So at the same time, apart from increasing their monetization, they also reduced subsidies, which was something that they did when they were in growth mode. So when Shopee was trying to gain customers onto their platform, especially during the pandemic and during the post-pandemic exiting out over the last, I think in 2021 or so, they gave a lot of vouchers and coupons and things like that to attract new members onto the platform, because I think the e-commerce space within Southeast Asia and within Singapore itself is actually really fierce, because in Southeast Asia, Singapore is the market with the most affluent population. And so because of that, you have TikTok Shop essentially competing in the same space as well as Lazada and Shopee. So during this point in time, where their main aim of the business was to grow customers, they gave a lot of subsidies, and they started to roll some of these subsidies back in 2022, because they realized that this was causing the business to be operating at a bigger and bigger loss. And so as a result, I think what we actually saw is that there was, immediate improvements in the business, especially the per unit cost of of their GMV, the gross merchandise volume, per unit of GMV, Shopee generated a higher core marketplace revenue, right? And in 2023, I believe they posted their first full year of profitability, and that is going to be represented by the graph that you can see over here. Let me see. Oops, that's not that. Yeah, so over here, you can see that they basically posted their first full year of profitability in 2023, and of course, they continued that in 2024. But this is actually what I wanted to show you. You can see there's these two graphs that you see. On the left-hand side, you can see that over throughout the first quarter of 2022 to the first quarter of 2023, you can see that their revenue actually grew by 36.3%. However, at the same time, their GMV actually stayed flat, right, at 17.4 million. So basically, what they are trying to tell you is that they're actually being more efficient in the way that they run their business. They're rolling back on some of these subsidies. They're actually increasing the fees. So despite selling the same amount of stuff, or despite having the same amount of transactions on their platform, they're able to generate a higher amount of revenue. And so this is basically the steps that they have taken back in 2022 and 2023 to streamline the business, to make it a lean business, and to turn the business profitable. Now, of course, with this increased profitability, I mean, it's not surprising to see growth actually slowed down. And so because of that, entering into 2024, this was something that they wanted to really focus on, to not just grow as they were in the past, but to actually drive profitable growth, right? So they basically saved a lot of money, did a lot of cost cutting in 22, 23, and then they took 2024 as a chance to reinvest into the business. They shifted their strategy, pivoted back into growth. So during this time, they actually planned to do it in a very profitable manner. This is vastly different from what they did back in 22 and 21 and 22, right, where they were just giving out freebies to attract people. They actually tried to really do this in a very profitable manner, and they use all this money that they have saved through cost cutting, and they strategically invested into integrating AI into their ecosystem so that the user gets a more personalized experience, and they really lean into the social arbitrage of live shopping. And so I think that's what they are. Yeah, and so they have things like this, which is very similar to what people are used to. I believe in the US, Whatnot is big, and so this actually started in Singapore through TikTok Shop and Shopee Live as well. So basically the same concept. The store owners actually selling on the platform. Yeah, so personally, I mean, this is just my perspective. This is not an objective analysis. But for me, with the way that I interact with the platform, I actually find TikTok Shop a lot more intuitive than Shopee Live. For the very simple reason, what TikTok does, or their algorithm, is because I'm already there scrolling, right, in the 10, 15 minutes that I have. Basically, okay, sometimes I plan to have 10 to 15 minutes, turns out to be half an hour, 45 minutes, or an hour. I mean, that always happens. But whatever it is, the point is that I'm on TikTok scrolling through random videos, and then the TikTok Live will just pop up. Right. So I don't have to be intentionally shopping for stuff. I just have to be in a moment where, I'm just killing time, and then I'm on their platform scrolling, and then automatically it comes up. Whereas in Shopee, this is a tab that basically I have to go into and to actively take a look. However, for me, the way I interact with Shopee's platform is that I already know what I want to buy. I'm actually going on using it as a search engine to look up different shops and where they're shipping from, how long their shipping will take, and things like that. And so because of that, I don't use the Shopee Live as often as I do TikTok Live. But like I said, however, if you look at the results, certainly it seems to be paying off for them. So I mean, I really wouldn't say that I would use myself as the average Shopee customer. And so based on the results they have put up, basically they have proven to the investors, they have proven to themselves that the trajectory that they have set the company on is working. And I think what they really need to continue doing going from 2024 to 2025 is to continue scaling the business, and that is exactly what they have done. So I've extracted this from their transcript at the end of 2024, where they actually confirmed that they have improved their monetization significantly, and a large part of this is actually driven by a growth in their ad revenue by more than 50% year over year, and their take rate also improved by more than 50 basis points compared to a year ago back in 2023. And so another way that they are able to scale profitably, especially going into 2025, is to improve the unit economics across some of their various logistic partners and in the different geographies that they are serving. So in Asia, primarily in Singapore and in Taiwan and in Latin America with Brazil, they have basically established a very good ecosystem that actually supports their delivery network. So I think what you can see, this is towards the end of 2024. They say that almost half of the orders in Asia were delivered within 2 days of order placement in the fourth quarter, improvement from the same period last year. And at the same time, we've reduced Shopee's overall logistic cost per order by 5 cents on a year-over-year basis in the fourth quarter. So they gain from all these operating efficiencies. This is both in Latin America as well as in Asia. And I think this is something that is very interesting because later on, I'm going to show you what management actually said in Q2 of 2025. And some of these delivery timing has actually been shortened even more, such that people can actually receive their parcels similar to Amazon, same day delivery within 4 hours. Right. So you can see that they're really taking steps to actually reduce the cost of delivery, improve the speed, and building up this whole ecosystem, this whole network of delivery riders, of delivery points within whatever location that they are serving. Okay, so from there, we also see them, like I said, apart from expanding just their logistics, you can actually see that they are becoming more and more entrenched within the Brazilian ecosystem. Now, I think if you have been investing in some time, you know that the competition in Brazil, in Latin America in general, is huge. If you're talking about financial services, they're competing with companies like Nubank, and Nubank is a company that we will be covering next week as one of the businesses. I know because previously I've covered Nubank only once on this channel, and I really to dive a little bit deeper after what we heard from their management over the last couple of quarters. And then if you're talking about, a logistics and delivery, yes, they are also competing with companies like Mercado Libre. So I think the competition in Brazil is strong, and I know that companies always like to present the best side of the story to investors during all these earnings call, but you can see over here that they have told us that they have become the market leader by volume, and we continue to grow fast, operating profitably. I think that is very important. I think investors were all scared away by how unprofitable they were. Later, when you see the graph during the valuation, you'll be able to see how unprofitable they were. And I think, yeah, they're promoting digital entrepreneurship to over 8 million Brazilians. So I think they're trying to embed themselves within the community over there. And I think by and large, it is working compared to some of the other geographies that they were in previously. And I think this is also largely because they have been able to focus on just one particular country within Latin America. And I believe that over time, as they start to establish a foothold in this area, that they're going to be able to, expand beyond this geography. So you can see basically what I want to show you is that over the 2024 and 2025, what you're actually noticing is that their GMV has been increasing. Okay, if you take a look over here, I'm not too sure whether you can see. In Q2 of 2024, GMV came in at $23.3 billion. And then in Q2 of 2025, this came in at $29.8 billion. Now, if you do the math over here, this works out to be around 27 or 28% year-over-year growth in terms of GMV. But the next slide really shows you where the operating leverage for the company starts to kick in, because you can see based on that 23.3 billion gross GMV, gross merchandise volume, you can actually see they generated $2.8 billion of revenue last year. However, in this quarter, Q2025 this year, out of $29.8 billion of GMV, they generated $3.8 billion of revenue. And so what this tells us is that their revenue is actually growing faster than their GMV, which means it's being less and less correlated. And a large part of that reason has to do with their on-platform advertisements being more and more popular among sellers, being more and more engaging, and having more and more users on that. So because of this, you can actually see there's some sort of structural change within their business model. Previously, when you model out GMV, you more or less get an idea of how much revenue they are going to be able to make through their e-commerce platform. But now they have introduced these digital components, which is their advertising services, and that has actually boosted the growth even more. So it's no longer a one-to-one correlation. And because of that, you can actually say that structurally, Shopee's e-commerce business has changed, and that is actually one of their biggest business arms within their whole ecosystem, right? So I think before going on, I do want to show you, before we talk about the valuation of Shopee, I just want to show you inside the app. I don't think many people manage to, or can, I'm not too sure how many of you actually can download the app, because since it's available in Brazil, I'm not too sure whether it'll be available like for you in the US or in Europe, because previously they were also in Europe before they exited. So if you go inside the Shopee app, I think this looks like the typical e-commerce app. For me, the interface has always been a little bit too busy. I like a cleaner interface, but you know what? This actually works for people in Southeast Asia for some reason. So I mean, since it's working, why fix what is not broken, right? I think it's just me, my personal preference. I like to have a cleaner interface. But they're trying to squeeze really as much information as possible over here. So if you take a look at the top of the screen, or the picture on the right, basically, this is Shopee groceries, where they actually deliver groceries to people. Now, for me, because most of the time I work from home, I don't really use a lot of these deliveries. If I need to do anything, I'll just get it nearby. But I think for many people in Singapore, I think the working hours in Singapore are fairly long. I don't think it's very it is not uncommon for people to just be doing OT 3, 4, even 5 times a week, especially during the peak seasons of of certain industries. And so because of that, I think a lot of my friends that I know actually go on Shopee or go on Grab to actually make use of their groceries platform to get it delivered to their house just for the sake of convenience, so that they can sleep in on the weekend and things like that. And so because I know people are talking about Grab's groceries side of the business and wondering, why is this being integrated into their platform, because this is such a low margin aspect of the business. I think a similar case can be made for C Limited over here. But I think the real issue over here is, or the real question over here is understanding what these businesses are trying to do. They're trying to build an entire ecosystem where customers come onto their platform for more than just financial services, for more than just typical shopping. And if, having the grocery platform on within your app, you do your grocery shopping within your app, and then after that, maybe, okay, you scroll other segments of their app, and then you might make a rash purchase here and there. I mean, that adds to their GMV as well, right? So for me, I think it makes sense. If you're talking about it from a margin perspective, no. But if you're talking about building an ecosystem, then definitely this is something that makes sense, and this is something that people actually use. And especially in Singapore, I mean, we have aging population. So I think as people get older, you want them to carry their heavy groceries back to their house, especially in Singapore. Not every single, the newer apartments that we built, we have lifts at every level, but for some of the elderly who are staying at the older apartment buildings, they do not have elevator at every single level, right? So this is something that I know that people use for their parents, so that they can get groceries delivered to them. They don't have to walk over to the grocery store, carry the groceries high up, and then take the lift and still walk up the stairs. So this is something that is suitable, perhaps within the environment that we find ourselves in Southeast Asia. Okay, so this is a look into Shopee Live. So you can see actually this first rectangle on the left, that is actually PopMart. I think if you were listening to Amit's channel, I think yesterday or so, he was talking about Chris Camillo talking about PopMart, and PopMart is actually extremely popular. They have releases every single Friday, and I know people who actually go to the PopMart store. I mean, I should really take a picture of the queue. The queue is crazy. Okay, so this is basically people can queue overnight just to wait for a release of one particular. There were a lot of cases of people fighting over figurines. I mean, beyond Labubu, there's so many other things that people fight over, which is quite crazy in my opinion. And to actually stop some of this rowdy behavior at shopping malls, they actually pivoted to do some of their releases online. So that's what you're seeing over here. And then in Singapore right now, it's durian season. That's why you see a lot of durian sellers. So you really get a variety of things on Shopee Live. However, like I said, this is not as intuitive as TikTok Shop, because TikTok Shop, I'm already scrolling on the platform. It just pops up into my algorithm. Whereas this, I have to intentionally go into that segment, right? So however, for me, how I actually like to use it is like on the right, looking for a coffee temper, type it in, the segments come out, you go into each individual shop, you can actually see how long they take to deliver, where they deliver from, and things like that. And then checkout. So the checkout is per, I think every single e-commerce business has that. And so I think one of the aspects of Shopee's mode is that they have this very extensive logistics network. So what you're seeing on the picture on the right, I hope I don't have any details over here. Did I? Yeah, I think I. So basically, let's say I wanted to order something. You can see that the first shipping option, I have a standard doorstep delivery. And right now, because I have a coupon for free delivery, my delivery is free to my doorstep. Otherwise, there's about a $2 delivery fee. Sometimes it's even more. Now, the second option that you see below is one of the ways that Shopee actually builds out their logistics network that is slightly different from what companies like Amazon do. And I think this is one of the benefits of operating within a very small country like Singapore. So these collection points, there are two types of collection points available. Now, the first type is what you're seeing over here. This is basically what we call a pick locker in Singapore. And they're basically metal lockers where the Shopee delivery riders will just bring a bunch of stuff. So maybe 50 people could be ordering from that Shopee rider, and then basically he takes all 50 orders to this metal locker, and he just has to stand in front of the metal locker, put it into each metal locker, and then close it. And basically what happens, Shopee will then send you a message through SMS with a one-time password. You take that one-time password, come to the pick locker, which is usually just 5 to 10 minutes walk from your house, and then you can basically unlock the pick locker, take out your item from there. Now, the problem with the pick locker is that there's only so much space you can have in the pick locker, right? And so to solve that problem, Shopee actually partners up with individuals who want to open up their house to be collection points for Shopee. So in my previous place, I actually had a Shopee collection point just 2 levels above me within the same apartment block, 2 stories above me. I stay on level 12. The collection was on level 14. And so every single time, if I were to get the delivery rider to deliver to my house, which is level 12 of that block, I have to pay a $2 to $4 delivery fee. But if I get it delivered to the collection point, which is 2 stories above me, I waive off the entire delivery fee. And so to me, I think it makes a lot of sense for me to actually deliver to these collection points. And because of these collection points, they do have an advantage over some of the other competitors in the region like TikTok Shop and Lazada. Now, Lazada, I do know, delivers stuff to the pick locker as well. I'm not too sure about TikTok Shop. So if people who actually use TikTok Shop very often, you can let me know whether or not, they actually TikTok Shop do deliver stuff to the pick locker. This one I'm not very sure. I really seldom use TikTok Shop. I think I've only used it once or twice to buy clothes from, I think, Mason Prince. So that's about it, or Essentials. And yeah, so I really can't say whether I know for sure whether or not TikTok Shop delivers to the pick lockers, but I do know that Lazada does. But this other layer that they have on top of that, where they actually engage in all these different partners to become Shopee partners and then to open their house as collection points, this is something that is only, for now, it is only exclusive to Shopee, and this is something that makes it a lot easier to deliver, and this will make me choose Shopee over another platform, right? So this is something that I think, only if you are living in the region that you are aware of these kind of things. I think as an investment, it's always important to understand what is happening on the ground beyond just looking at the numbers. So like when I was investing in SoFi, because I have friends who live in America, I have relatives there, I can speak. They actually went there and did some digging for me on my behalf and to try and understand the sentiment on the ground. One of my friends even went to SoFi Stadium for me. So I think it's things like this that makes investing exciting, makes investing something that really goes beyond just looking at numbers. Because if it's really just looking at numbers, then everybody can just plug it into some sort of algorithm, some sort of formula. But it's really understanding the business, understanding the intentions of the business with its consumer, and to decide whether or not this actually makes a good business. So once you check out, you have chosen where to actually, where you want it delivered, you can actually check out. You can see your credit card is over here. And then the second 2 options, you can see Murray Credit Card Instant Checkout. So this Murray Credit Card basically is a credit card offered by Murray Bank. Murray Bank is owned by C Money, and this is basically a digital bank that is owned by Shopee. So if you deposit money over there, and if you use that account to actually pay for your Shopee purchase, you actually get more cashback, right? And then S Pay Later at the bottom, this is basically their buy now, pay later option, also operated within C Money. So you can see their whole ecosystem actually works together. They have their e-commerce arm, which is Shopee. They have their gaming division, Garena. And then to help users fund these 2 ecosystems, they actually open up C Money. And then C Money basically provides the financial backing. If users want to use their products to actually make payment on their platform, then they get actually better discounts, better cashbacks, and things like this. So you can see over here on the right hand side, this is my really dominant account. I literally open it just to try to make one purchase on Shopee. It's not too bad. You get a 1.88% interest per annum. This interest, as with all digital banks nowadays, the interest is credited to you daily. So you can actually see when I had a bigger sum of money over a period of a couple of months, I made around $438 in interest. This was back when this interest rate was actually higher, around 3% or so. And you basically get this amount of money credited to your account every single day, right? This 3%, annualized on a daily basis. So this is something that actually that makes their platform interesting to other people. So I think when it comes to their financial services segment, they have already told us that their loan book is growing substantially, and at the same time, their non-performing loan ratios remain stable at around 1% in Q2 of 2025. So when we go through the framework later, I'm not really going to. See, Shopee is one of those companies, right, that is slightly different from what I am used to, because usually my categories over there are either you are a financial institution, and then we use your credit ratio, your capital ratio, as well as your NPL to judge your performance, or you are not a financial institution. However, Shopee is just one of those companies that happen to have both. Haven't really thought about how we can actually categorize them within the framework, and that is something we might perhaps have to discuss later. And like I said, the whole purpose of having these live streams over the next 10 days is really for me to iron out this framework and then to try and apply them and track some of these companies. So 1%, literally right on the line between our framework. If I'm not wrong, our framework goes less than 1%, between 1 to 2%, and then above 2% is not what we want to see. So below 1%, 1% is basically literally right on the dot. They have decreased their non-performing loans ratio. So they have shown that they are able to underwrite fairly good quality loans, and they're actually improving on their underwriting. So I think we really have to just pay attention to this segment of the business. I think for me personally, when it comes to this is where I say I might be biased because I have investments in SoFi where they work with people with high FICO score. And I think what Shopee is doing, offering banking services to the unbanked, is critically important, especially to people in this region, for them to break out of the poverty cycle and things like that, and to really empower them. However, at the same time, I think if you are thinking about it from a business perspective, I think this current group of people who have taken up loans from Shopee haven't really been tested yet through any economic downturns. And so all we do have is models and basically data from other countries, and you're just trying to overlap it over Shopee's loans, not Shopee, sorry, C Limited's loans, and to actually determine how they are going to perform. However, the truth of the matter, and I'm not trying to target any group of people over here, is that because when you're reaching out to unbanked population, there is no certainty how they would respond. There is no historical data that is directly linked to them, which is basically the nature of unbanked population. There's no direct historical data being linked to them to tell you how they would respond in any sort of economic downturns. So you really don't know how safe or how healthy is the loan book, or whether or not their underwriting, they've really given themselves enough buffer. So that is something that is clearly a risk to the company. But at the same time, you also have to understand that with risk comes, of course, reward as well, which is that this unbanked population, especially within Southeast Asia, is a large group of people. It is a large market, and as they can empower them through all these banking services, they get these people onto Shopee's platform to be sellers on the platform as they generate income. Perhaps with all these consumer data, it is easier for them to underwrite the loans because they can actually see the cash flow of the business. So that's the first thing. But second thing, it also helps to lift these people out of poverty as well. So I think at the same, they are really empowering the people within this area. And I think this is the same strategy that is being applied for Grab as it is for Shopee, just that with Shopee, they're doing it through e-commerce. You're selling stuff on their platform, and with Grab, you're doing delivery and things like that on the platform. Or if you are small owners or with F&B primarily, you can advertise your business through Grab. Similar business models targeting different segments, e-commerce versus delivery and F&B, right? So for me, that is how, Grab. So like I said, these 10 days, not covering Grab, I may come out with a separate videos outside of these 10 days that I really want to talk about Grab, because I have a crap ton of things to say about SoFi, about HIMS, about Grab, but I've been so busy preparing these videos for these 10 days that I haven't really got around to that. But I think, you can see over the last 3 days, I started not knowing how to use my streaming setup to having this rectangle over here where you can see my face and you can see the presentation. Hopefully that means it is easier for me to live stream to talk about stuff and things like that. So, hopefully, I am not promising anything. I will try my best. SoFi, HIMS, Grab, apart from these, sometime during these 10 days, I will release a separate video on these 3 individual companies as well. Okay, especially talking about their most recent earnings. I've done so on SoFi, but I just want to talk a little bit more about some of the news that we have heard recently. But for HIMS and Grab, I haven't really done anything. So apart from that, lost my train of thought suddenly. Okay, so this is what I was saying earlier. Digital financial services, you can actually see their non-performing loans ratio dropped from 1.3% down to 1%, while their loan book is increasing. So, really, you can have no complaints over here, apart from some metric that I have written on the framework that that I read somewhere that says, less than 1% NPL is actually a good ratio, and they are at 1%. So they're trending in the right direction. Give it another quarter, they report 0.9, then they can get additional points over there. Right. So finally, like I said, moving to digital entertainment. For me, if I'm very honest, not that I'm much of a gamer, the only thing I actually play, I honestly only play 2, maybe 3 games. The large majority of my year is consumed by EAFC, FIFA. If you guys know that, then when I'm bored, I end up playing Pokemon or Clash of Clans. That's about it. I wouldn't consider myself a gamer by any stretch of the imagination. But yeah, personally, I've tried some of the Garena games. To me, it honestly isn't that fun. I can't understand games like PUBG and stuff like that. But I know people play it like every single day. And oh, you play FIFA as well? Oh, fantastic. Yeah, so, you can let me know later on whether or not you are getting the pre-order. Yeah, I mean, and whether or not you have seen the latest release. So basically, apart from that, I think you can see that it was a pretty strong quarter for their gaming segments. They have partnered with. That's why I say I think this was during their earnings call. I was mentioning this earlier in the video that they have partnered with games like Arena of Valor, EA Sports FC Online, Call of Duty. So especially like Call of Duty, I know people are always complaining about the game mechanics and things like that, and they don't seem to be really doing anything to fix it. So I'm not too sure whether this has to do with the producers of the game, or is this to do with just Garena? I'm not too sure how it really works, but I just know more people are using their gaming platform through all these mobile apps, and they have increased their bookings from 23% projection for the whole year to 30% for the rest of 2025. So to me, at least, I personally don't use their gaming platform, but I think it's good to see that there are people out there that actually enjoy using their gaming platform. So if I take a look at the balance sheet, okay, like I said, I need to do this so that at the end of the day, we can take all this information, put it into our valuation, and put it into our framework. If you take a look at the balance sheet over here, current assets, cash and cash equivalents, they have in June 30th, you can see they have around $4.1 billion in cash, and then short-term investments around $7.2 billion. So total, you can say they have close to around maybe $11 billion in cash on hand. And then if you take a look at their liabilities in terms of borrowings, they have around $306 million. So they have much more on hand than that. So they are really, really in a very comfortable position. Really not in any danger at all, right? Yeah. And I think that's why I say, despite my worry about the data behind some of the people that they are offering all their banking services and their loans to, the unbanked population, I don't know how they would manage in an economic downturn. But looking at their balance sheet, they have a very healthy balance sheet, which is why I don't really have a problem with that. Okay, so using these data, we are going to move on to talk about their valuation, and then apply all of this into the framework. Long Hims, hi Samir. Long Hims, SoFi interested in Grab, right? Thanks for being here. Really, I'm really trying to, yeah. I'm hoping to make this into at least 3 times a week eventually, perhaps even more than that, depending on my schedule. And one of the 3 times, like I was saying last week, every fortnightly, we will do a deep dive into a company. And I think the framework over here, it's not the same depth as what I do for my individual videos for SoFi and Hims, but that is because those companies, I've already decided to take up a position in them, and that's why as I have grown my position, my research into these companies have grown bigger. But what we are doing over here is to help you decide whether a certain company is worth your time digging a little bit deeper, right? So this is basically, I would say, the first 8 to 12 hours of research basically being condensed down into a 50 minutes to an hour plus video, so that you can understand the thought process behind choosing a company. Yeah, perhaps I might turn Grab into a live stream like this, because I know a couple of people in previous videos have also been asking me about Grab, and to go through their Q2 earnings as well. Give me a minute. So nice. So where are you from, Samir? I mean, if you're eating lunch when you're listening to my videos, you should be from the US, I presume. Right. Okay, that's pretty cool. I mean, I'll be near. I'll be in Vancouver in September for a holiday, so pretty near Washington and Seattle. For a moment there, I was deciding going down, but decided to fly up to Alaska. But that's in September. Okay, give me a second. Let me pull up my valuations. Valuations. I believe this is the one. Yeah, here we go. Right, let me make myself smaller. All right, let me zoom in a little bit. Okay, so you can see this is basically, I've been using this file to track the earnings of C Limited over the last couple of years. You can see at the start, 2021, explosive growth, and then their growth slowed all the way down. You can see the top line year-over-year growth from 100% year-over-year down to single digits, and that is basically what happened to their stock price as well, right? That fell all the way from $372 down to $30, $40 range. And so that is when that happened. And you can see this slowly starting to ramp up growth again in the 20% range in 2024. Then coming into this year, they have been growing consistently around the 30 to mid 30% range. I think this is what you're going to see in their earnings as well. Let me just zoom out a little bit. If you can't see the numbers, please let me know in the comments below as well. Gross profit came in, yeah, I think more or less that. I mean, the gross profit has been pretty consistent in the mid 40% range. I wouldn't say that this is, yeah, I wouldn't say that this is good or bad. I would say that this is more moderate in line with what their industry average does. But they have so many different businesses within their holding company C Limited that it's a bit hard to judge. You can't really say that this is a financial services business. You can't say that this is fully e-commerce and things like that, because there's so many different aspects of their business over here. So it makes it a little bit hard to judge. But gross margin has been pretty consistent, increasing. It actually fell in 2023 for a moment to the low 40% range, but now it's back up. So you can see previously, if I scroll back, yeah, they were operating at 30%, in the 30% range back in 2021, 2022. This increased to as high as 47, 49%, and then now they are basically climbing back slowly to that level in a very measured manner, right? So it's not just growth for the sake of growth anymore. Operating income, okay, consistent, 9.3%. I like to see it when margins are consistent in the company. And then net income, $406 million with the 7.7% net income. So this is good. Shares outstanding, 592 million shares at 69 cents EPS. So cash flow from operations, this came in at $1.6 billion. This is a big increase from what you are seeing previously, right? So this is the cash flow margin or cash flow as a percentage of revenue. CapEx spend around 4.1%. But you can see that CapEx spend is not very consistent. Some quarters, they really ramp it up. Some quarters, like last quarter, there's no CapEx spend at all. So free cash flow this quarter really seen a boost, 1.399, we call it $1.4 billion. Okay, so let me zoom out a little so that you can see the trends that we are dealing with when it comes to C Limited. So you can see revenue growth has been growing in a very healthy manner for them. Revenue has been growing steadily, but the growth rates, which is this orange line, stagnated for a while, which was what we represented earlier on, single-digit growth. And you can see they are back on the path of growth, and that is why the stock price has followed this graph. So actually, if I overlay their growth rates onto the stock price, you can see that this was in 2021, Q1 of 2021, this was basically the peak of their growth rates, which was also more or less the peak of their stock price that declined. And then over the last couple of years, they spent time restructuring their business, turning around the company, and then going back up again. So like I said, was this a missed opportunity? Like that was right in front of me? You could say so because I'm in Singapore and Shopee is in Singapore. But personally, for me, I hardly do any online shopping, right? So because of that, you know, I looked at Grab first before I even looked at this, because I use Grab, but I don't use Shopee. And actually, I've asked a lot of my friends. I think right now, if you ask most people in Singapore what is a more critical app on a day-to-day basis, people would tell you Grab, not Shopee. Yeah, people will likely tell you Grab, not Shopee, because it covers our transport, it covers our food delivery and things like that. Shopee is more of during your leisure time, you want to shop and then you're lazy to go out. This is where you get it. You want to get household appliances, you're lazy to go out. This is where you get it. It increases your quality of life. It adds to your convenience, but it is not. If I take away Shopee today, right? If I take away Shopee today, people are going to live life pretty much the same. You can just go to Lazada. But if you take away Grab, then basically, their counterparts, people like Gojek, or there's another app called Tada, might not give the same level of service, might not give the same level of convenience compared to what Grab does, because of which is why, despite Grab being a smaller company, I do think they are more essential to the day-to-day life of people within the region. Yeah, but that is just for me, and maybe I should do a video comparing these two companies, right? Yeah, so you can see operating income. This was why the first couple of years, people were scared out of their minds because of how unprofitable they have become. They have shown that they are able to really turn the company back on growth, back to profitability, and maintain that profitability. And while that is growing, net income, same thing. You can see wildly unprofitable. And then after that, very inconsistent. But over the last, call it 6 to 8 quarters, they have shown that they have grown consistently in a very profitable manner. And yeah, I think this is going to be reflected in their end of year earnings as well. So you can see this is literally the same thing all the way through every single one of their profitability metrics. Unprofitable in 21, going into 2022, and then they suddenly flipped the switch, turned profitable, kept growing. Now they have streamlined the company, adjusted their cost structure. They are managing to grow in a very profitable manner, and then now they're ramping up growth while still maintaining profitability. And this was something that the management said during their Q2 2025. Now they have put their company in a place where they can go to the next phase of the turnaround, which is ramping up growth while still not just maintaining profitability, while growing profitability at the same time. Right. So this is something that that to me is exciting. To me, that is why the stock market is excited about this company. Okay. And then so on an annual basis, you can see this is their revenue. Now, okay, I just want to make just to let you guys know how we are doing this, because you see, like when we did the Nike video yesterday during the valuation, we could use Nike's 2025 full year revenue because their fiscal year 2025 ends in May of 2025. However, for Shopee, we follow the typical fiscal year. So the whole of 2025 will end in Q4 2025 in December. Because of that, this number that you're seeing over here, $19 billion in revenue, is basically the trailing 12 months revenue. Okay, so this is not my projections for what they are going to make in 2025. This is basically the trailing 12 months revenue. So you bear that in mind when we're doing the projections, maybe a little bit inaccurate because of that. Same thing for the gross profit and everything. All these numbers are taken from fiscal.ai, and then basically I'm just using the trailing 12 months numbers for their profitability and their revenue. Okay, so from here, let's go into the DCF. Okay, last couple of days, I've already explained what's the WACC. So WACC, like I said, if you want, you can calculate it over here, which I have. You end up with around 10% WACC. Okay, and then terminal growth rate, 3%. So revenue, $19.3 billion, which represents, I mean, how much is it? Yeah, 15% year over year growth. I don't think they will end up with that number this year. I think it's going to be more than that. But you know what? Hey, let's just stick to 15% for now, because this is what we have. Like I said, even if it's a little bit more conservative, that's perfectly fine. Cash flow from operations, this is the number that we have, $4.5 billion, which is a 23% cash flow margin. So yeah, so basically, since this is 20%, can they go up to 23%? I mean, let's just do this, okay? They will slowly increase their cash flow, because they have told us, you see, when I increase certain things, I need to be able to justify. The reason why I have decided to increase this is because, okay, they are currently operating at 23.5% cash flow margin. management have told us that they have already positioned their company in a way that they can grow revenues in a very profitable manner, and not just maintaining profitability, but growing profitability at the same time. So let's just assume that that's possible. They'll end 2030 with 23% cash flow margin, right? Actually, that's not really growing, but I mean, like I said, don't mind being conservative. This is CapEx as a percentage of revenue. I'm not using this 7% number because this was before all the cost cutting. Now with all the cost cutting, you can see 1.8%, 1.8%, 1.9%, 2.7%. So I'm just using 2.5% to represent their CapEx as a percentage of revenue to get our numbers over here. Now, cash. Give me a second. The cash that they have, yeah, it's around I think we were saying it's around $4 billion, right? Yeah, let me just take a look. Cash on hand, is it $4 billion? All right, I just want to point out something to you over here. When I did this, but the first time there was a mistake over here. That's why I used this $3.9 billion. Let me just take you back very quickly to when you are doing a DCF. Correct me if I'm wrong, if those of you who might have a little bit more experience building a DCF, but correct me if I'm wrong. When you count your cash in the DCF, you don't count restricted cash. So you only use this $2.165 billion, and then you add the short-term investments. You don't count the restricted cash at all. So initially I got this $4 billion or $3.9 billion because I was using the cash plus restricted cash. I should be using cash and short-term investments. So that would make around let's call it $9.3, $9.4 billion, right? So, I mean, yeah, $9.4 billion, debt is around there. Is it? Debt 306. Okay. So 306. Where is it? Okay, shares outstanding. So you can see if you use the perpetual approach, you get a value of around $162.60. Yeah, so based on this today, if you think that these assumptions will come true, right, which is revenue growth will be 20% next year and then slow down to 15%, eventually 10% by the end of the decade, then today's value is overvalued on the perpetual approach. Now, these assumptions are extremely, extremely conservative, which is why I always say I don't like to. One of the reasons why you can see when I do my valuations, even with HIMs and things like that, I don't really do a DCF because there's a lot more assumptions to make actually, because you have to assume their growth rates going all the way until 2030. I mean, who knows what's going to happen? It's hard to project their growth rate beyond 2025 and 2026, let alone to 2030, right? If you ask me, I don't think they will be slowing down to 10% growth in 2030. But like I said, just to be conservative, I'm leaving the numbers over there. Okay, EV to EBITDA multiple. Let's see if I go by the multiple approach. EV to EBITDA, what are they trading at right now? Let me just share my. Okay, if you look over here. Oh, sorry, I think I need to switch sides. I believe, yeah, because it's going to be, data's going to be over here. Ratios. EV to EBITDA. EV to EBITDA. Okay, it has been in the 50. Okay, so in 2023, when it was so low, it was 26 times EV to EBITDA. So you got to imagine in 2023, when they were growing single-digit percentages, EV to EBITDA was 26%, right? And they were not as profitable, just turning profitable that year. Last year, in 2024, they were trading at around 54 times EV to EBITDA. All right. Using these assumptions, okay, I go back to using these assumptions. If I were, if I were to bring this back to our valuation, so 25 times EV to EBITDA may not make sense. Why? Because you are assuming that the perception or the market's the way the market perceives C Limited is going to be worse than when they were growing their revenues at single digit and they barely turned profitable. So I don't think that is going to be the case, which is why I'm comfortable perhaps increasing this to maybe 32, in between 25 to 35 times EV to EBITDA. I think that's what I think is a fair value for them. Yeah, and assuming they're actually buying back shares, but let's just assume no share buybacks, just stay the same around in a 500 million shares range. With that, you get an average. Okay, sorry, I just need to zoom this in. You get an average here of around $293 if you average out the both methods. Give yourself a 10% margin of safety. I mean, for me, I feel pretty comfortable giving them a 10% margin of safety because I'm in Singapore. I see the operations, I see the number of people that use them. I trust the scale of their operations. I trust the management. I feel comfortable with the 10%. Last night with Nike, we gave them a 15%. Isn't Nike a bigger brand? You might ask me. Yes, Nike is a bigger brand than Shopee, no doubt about it. But where are they in that stage of a turnaround? Right, Nike, we just had Elliott Hill come in and put the structures in place for the turnaround. This is literally the 2022-2023 moment that Shopee were in previously. We haven't seen the results of all these things that Elliott Hill has put in place. Now, like I said, if you had bought Shopee back then in the $30, $40 range, and you can actually see what's going to happen, how this is going to play out over the next 2 years, you will have benefited greatly, being over 30, buying in the 30, 40, even $50 range, and benefiting all the way up to today. Hi, Justin. So, stream on Grab. Good question. Previously, I was saying that I would not be doing Grab as a part of the 10-day stream, but I might do a bonus stream sometime, perhaps in the nighttime, the US, which is morning of Singapore time, sometime next week. Yeah, because a lot of people have been asking me about Grab, and I wanted to do it as a separate video, but I thought perhaps if I do it, be 8, 9 p.m. Eastern Standard Time. And then most of you guys should be after work. You can hop on as well. People in Singapore, they should be on the way to work. They can also listen into the live stream as well. So I think that might work for everybody. Yeah, so I initially wanted to do it as just a standalone video, but I think I might do it in a live so that people can actually ask questions here. And then I can actually show you the app in person. And I guess it's quite fun to do it in the morning because you can actually see during the peak hour how the charges are like, right? Because I can actually share the screen on my phone, and then you can actually see how the app works, especially in the morning and things like that. Yeah, so I might even order my breakfast on stream, and then you can actually see the whole delivery process and things like that. So that might be something I want to do next week in the morning. Morning for me, nighttime for you guys. Yeah. So if you take a look, like I said, for me, I like to invest in companies with 50% upside. So over here, you can see that the potential upside, 48%. Would I just write it off because it's not 50%? No, because I also know that I've given very conservative estimates over here. Yeah. So I think where I would put this is that I would say that it's very similar to Nike. Nike have established some of the things that Elliott Hill really wants to do for the company to turn them around. And if you're buying in today, Nike, you're buying in without the assurances that all these things that he has put in place will work. Similarly, if you bought Grab at $40, $50, yes, it was cheap, but you were also buying it at a time where you had no assurance that the steps that the company was going to take will definitely play out. Today, you're buying it at a point where everybody can already see the turnaround take place. As from the words of the management, they've already ended stage 1 of the turnaround, and now it's stage 2, which is ramping up growth and profitability at the same time. And that is why today I believe that they are slightly on the richer side of the valuation. Can they go past all-time highs? I think sure. This is why I say if you just purely follow the DCF, sometimes it might not be 100% accurate, right? And so I think I'm actually quite interested. I haven't managed to run C Limited through the framework at all. I haven't even taken a look at it and how it would score. So I think this is a good time to use the framework to see whether it really works and give us an accurate representation of a company like C Limited. But for me, if I look at the numbers, I would say that strong numbers, but similarly, valuation is reflecting that it is not at a cheap valuation by any stretch of the imagination. If you use conservative estimates. So it really depends on how certain are you about the estimates that you have. Okay, so let's go to our framework. Okay, before we go to our framework, is there any questions that you guys have about Shopee, Grab in general before we carry on and while I pull up my Excel spreadsheet? Okay, Windows, just my checklist. All right. Okay, so you can see over, let me shift myself to the right side. Okay, so you can see over here, I think what we have is the checklist that we used yesterday for Nike. Let me just copy this so that, yeah. Move or copy, can I do that? Can I not copy? Oh, okay. Move to the end, create a copy. Okay, I'm creating a copy so that I remember all the numbers, right? So if you can see at the bottom, I have a tab for PayPal, I have a tab for Nike. So today I can work on this with C Limited and not be worried that the numbers are changed, just to double confirm. Nike numbers, yeah, still stays as Nike. All right, fantastic. So, okay, compounders, let's see, Grab, software IT. Okay, let's see where we end up with now. The total addressable market for Grab. So they are, I would say that definitely they are, the TAM is more than 10x of revenue because they're in financial services, they are in e-commerce, and then they are in gaming. It's 3 different business verticals over there. Not worried about it. The CAGR of these definitely, I would say that they are not a company that is actively trying to disrupt the space. They are trying to offer high quality services within that industry to people in Southeast Asia and things like that. And so basically, I wouldn't say that yes, although the TAM might be growing at a faster than 4 to 9% CAGR, but they are not a company that is actively trying to be on the cutting edge of technology, trying to introduce. They're basically replicating what other people are doing within a different region and adding their own twist to it. So because of that, despite I think the TAM, especially in the might be growing faster than 10%, but I'm only going to give them a 1 point for this instead of 1.5 because taking into considerations that they are not the company that is driving innovation within the space, but they're making use of innovation that people have driven in the space to apply it to different regions. So that's how I actually grade it. So that's why this whole framework, you really have to talk it through. There are a lot of things that you can't represent purely by words. You really have to understand the business and where they stand within the overall market. Is the business easy to explain? Yes, you're right. They have a platform. They sell ads on the platform. People use their platform to sell stuff to people and they take a cut. Transaction dollars, right? Yeah, gaming, people spend in-game currency, they make money. So I think it's pretty financial services, pretty straightforward. Okay, cost. Is there a switching cost? Let me see. Network effects, I would say strengthening, clear. Switching cost. Is there a switching cost? I don't know. What's stopping me from using Lazada? Well, it's the network effects that are stopping me because they have this whole logistics framework that is being built out. There's no switching cost per se. If someone gives me a higher discount on another platform, I'm not like loyal to Shopee by any stretch of the imagination, to be very honest. Yeah, I mean, that's me personally, right? If you differ from my opinion, you might score this differently. I'm not going to give them a point for switching cost. Low cost advantage. Do they have a low cost advantage? Ads on the platform. No, they don't have a low cost. They have a lot of optionality. That's for sure. They don't have a low cost advantage. Do they? I mean, I guess it depends how you see it. Like the financial services aspect itself, yes, they do not have a low cost advantage there, but because of the ecosystem that it is in and how it helps the users that are on Shopee, that are on Garena, access cheap credit, then perhaps you can say that there's a low cost advantage because they own their own bank, right? Compared to some other companies like Lazada. So, or even TikTok Shop. Low cost advantage? I mean, I don't know. I wouldn't say no. Okay. Sorry. Strengthening clear. You know what? Honestly, I'm more inclined to say no low cost advantage. Honestly, I mean, personally, I don't think. I think it's a little bit of a stretch. Economies of scale, definitely yes. Regulatory frameworks. I think when it comes to banking, definitely yes. It's not built out entirely, but they are strengthening. Intangible. Yes, I think people. Okay, within they are not a worldwide brand, but within Southeast Asia and within Asia, they are a very recognized brand, right? I literally see their ads everywhere. So I think they are, I can give them a point, half a point for that. Revenue growth is faster than TEM, no problem over there. Revenue growth rate, okay, we have seen above 30%, right? The only slight hiccup was this quarter where they grew 29.8%, but really doesn't matter. Last 4 quarters above 30% growth, no problem. Multiple scalable revenue streams. Easy to pivot into new TAM, definitely. No customer concentration, also very good. And then gross margins. I would say, like I said, this is not, they don't have fantastic gross margins. It's a little bit hard to judge because there are so many different businesses. I would say moderate gross margins relative to industry, stable, and it is stable trends, right? It's been low to mid 40s. Definitely strong cost control. I mean, you can see the passion that the CEO have. If him and the management team take a pay cut for one whole entire year to drive costs down, I mean, strong cost control. You can't fault them for that. Okay, the other side of the thing. So let me switch myself back. Okay, I'm over here. This is where I was saying that I don't know how this actually fits in, because in terms of their non-performing loans, it's part of the bank, but my model here doesn't really include that. And if I include that, then the scoring system will be a little bit skewed because the total plans will be different. But definitely their net cash, goodwill less than 30%. They're very, very net cash, right? They have over, even if you don't count their short-term investments, over $2 billion in cash, and then with only $300 million in debt. So no problems over there. Goodwill and 30%. I really should take out this goodwill here because it's already represented here, right? Because I wanted to represent two different things. Net cash, people could be net cash but made a horrible purchase and have a ton of goodwill on their balance sheet. So yeah, I really should change that. Yeah, so I think for that, I'm going to give them full marks for this. They're non-banks, they're not negative. Their free cash flow has been improving over the last 6 to 8 quarters, so positive free cash flow. CEO, he is the founder, mission focused, definitely. I mean, like I said, if a CEO is taking a pay cut for the company for an entire year, I mean, that is why you invest in founder-led companies, right? Buybacks, high insider ownership, yes. Okay, so this is everything that they have done. Reduce debt, yes. Low to no risk with no action required. Exit unprofitable segments, already done. So they are no longer in some of the unprofitable segments. Diversify suppliers and customers. Well, they have already built out this entire. I would say that maybe they're actually actively working towards this in some other countries, right? In Singapore, fully built out. I would say more or less. Like Shopee collection points, I literally have like 3 around me right now. So, but in other countries, I don't know. So let's just give it as actively working towards. Simplify operations, they have definitely done that. Improve liquidity, no to no risk, no unnecessary M&A. Well, I mean, they score pretty well. I mean, over the last 2 to 3 years, you really see them handle the risk very, very well. I think right now they are in scaling mode where it's not about where it's really not about managing risk. They've already managed the risk in the last 2 to 3 years. A lot of these things are no longer risk. They are now that, in a sense, diversifying their suppliers and customers in a way of building out larger supply chains and like that. Core business suffers in downturns. You would have to say it does. It's e-commerce after all. In a recession, that will suffer. And yeah, financial services, like I said, that is a risk that we really don't know how it's going to play out. Should we really see a deep recession in the Southeast Asian region? And I think, yeah, I don't know how gaming will play out. I would think that most people will not spend so much on games in a recession, and parents will not give their kids money to spend on games during a recession. So -1 for here. They have not you see, they technically they were founded in 2009, so more than 10 years. But they haven't cited. I'll give them. I mean, I know that this description doesn't exactly, like, it's not 5 to 10 years. But Shopee is 2015, so that's 10 years. It survived one bad market cycle. Yeah, I guess. Yeah, I wouldn't say they have survived multiple. So one. So let's see where that puts them. Okay, story driven. In a way, yes, because the valuations doesn't make sense for them. That's why I think that's where they lose some score. Let me see. Yeah, and I think that's where we find ourselves. C Limited is actually story driven. Okay. So like I said, just to remind you, story driven is over here, between 22 to 27. And I think this is where I like this framework to more or less be working. I don't want to be putting every single company in the elite compounders or high quality. They should be, majority of the companies shouldn't be in the elite compounder space. Most of them should be story driven, lower amount and high quality, but a lot of them should be over here, because at least for the way that we are investing, a lot of these companies that we are investing in really are story driven companies, right? So the turnaround in C Limited has been completed so far. However, the second phase, whether or not they are able to successfully ramp up growth while maintaining and even increasing profitability, like I said, still to be seen. If they can do that, valuation makes sense. If they are not able to do that, then it might be a little bit on the pricey side today. So it really depends. Now, if you give me a 10-year time horizon and ask me, can they beat their all-time highs? Yes. If you give me a 2 to 3 year time horizon and say, can they surpass their all-time highs? I'm a little less certain about that. Okay, so with that, I think that will bring our live stream to an end today. Hopefully things are a lot more clear today than they were the last couple of days while I'm trying to figure things out. Tomorrow's company will be on Enphase, and I think that is very interesting. Enphase is a company that, in a sense, I got the narrative wrong. I will be very honest, I got the narrative wrong about the company. But when I look at the company, and you consider the macro environment that we find ourselves in, with Trump and all that, I think it is still it's not something that I'm in an urgent need to cut, right? And then I'll spend some time tomorrow also talking about the option strategies behind Enphase and how I'm planning to turn it into a profitable position. Because when I first started buying, it was in the $60, $70 ranges. I averaged down. I think now my average cost is in the $51 range. I'm a little bit tempted to buy a little more, to bring my average down to the $40 range, so that it's easier for me to roll it out through a covered call. Yeah, but I think we'll discuss more of that tomorrow. So tomorrow will be Enphase. We will take a break over the weekend. And then we will be back next week for 5 days straight, doing 5 different companies. And sometime during the week, I know Tuesday I can't. So apart from Tuesday, sometime during the week, likely it's going to be Wednesday or Thursday, I will hop on the live stream in the morning, Singapore time, evening time for you guys in the US, show you how someone in Singapore uses the Grab app in the morning. We will take a look at the delivery fees and we'll take a look at the delivery fees and delivery time, because oh my goodness, if you're trying to order food during peak hours, you can wait as long as 45, 55 minutes. And these are things that when I listen to people talk about Grab on the internet, it's not that they don't know what they're talking about. They don't really have that first-hand experience, and the scaling really isn't as smooth as some people make it out to be. So yeah, but I do think at a $20 billion market cap, they are definitely more undervalued than Shopee or C Limited. You can see the inner workings of the app, how the deliveries work, how does the transport side of the app. What do you? Yeah, I don't even know what to call it now, because what do they call it? Transportation? I don't know. We just call it Grab. Like, I want to Grab to somewhere. Okay, like I said in one of my videos, Grab has really become synonymous with traveling in Singapore, at least. I will Grab to somewhere. So let's call Grab. That's what we say. And call Grab in the context of the conversation can mean let's call for food, let's call for a taxi. So I'm just going to put it out there. And I think it makes it interesting. You can actually see how it works, how the fees are like when it's during peak hour traffic and when you're ordering food at during different times of the day. So I think that's something interesting. And then we'll talk about the valuation, what the company has spoken about in Q2 of 2025. And they have this bunch of cash on hand. Let's explore what are some possibilities that they could do with that. Right. And so with that, with that, I'll bring the stream to the end and I'll see you in the next one.